Hello, my name is Manny Kagan. I'm a mortgage master and founder of Mortgage Solutions Academy. My idea was to help you to understand better mortgage business because this way you'll be able to find buyers who can qualify for alternative mortgages. But before I'll tell you all these nuances of mortgage business, I will share with you a story, my personal story. I was born in Riga, Latvia. At that time, it was occupied by the Soviet Union, so we learned Russian in school. And at 15, I became apprentice to the tool and die maker in radio factory. I had to learn how to use different machinery, but I also had to learn how to use different tools. Uncle Vanya, whom I called master, had 16 hammers in his drawer. They had different heads, different lengths of handles, and I had to learn how to use each of them in what conditions and whatever I needed to produce. I never became toolmaker because at 17 I became student in Riga Polytechnical Institute, and then I got married at 20. And 21 I went back to work in the same factory, but this time as an engineer. My knowledge, what I've experienced I gained before learning tools, helped me in my work. And then at 25, we immigrated to Israel. There, I was industrial engineer and I was involved in building commercial factories all over the world. When we came to United States in August of 1980, I had to go through different transformations. I received my green card as a translator. My last job before becoming a mortgage broker was vice president of operations of women high fashion company. All of these experiences which I gained, and I probably had 10 different occupations, helped me to become a mortgage broker. Because when I started, I was told that I will see my first commission after 6 months. After 6 months, I was top producer. After 9 months, I opened branch office for the company. After 12 months, I quit the company and started partnership with other people, mortgage brokerage company, which probably was one of the first one in the country. Moving forward, in 1985, together with my wife Alpha, we started Pacific Bay Financial Company, which is still running and is still working together, and we're still married for 55 years. I learned a lot. But I also learned how to use tools. Today, I have at least 16 hammers, or even more. Those tools which we use to help different clients. And this is what I'm going to share with you. Now it's up to you to learn or not. I hope you will, and I'll help you. I promise. Today we'll start learning about different ways how mortgages are done. However, before we can read, we have to learn letters. In mortgage business are called C's, and there's 5 of them. Actually, I made 5 of them, and I included them in a book which I published 10 years ago. It's called The Mortgage Game, 5 C's and How to Connect Them. So what are the 5 C's? The essence of mortgage business or lending is based on very simple premises. You need to have collateral. Now, some lenders or government thinks that you don't need to have collateral. You can get a loan without one. And we'll talk about those programs as well, where it's 100% financing. But in general, to enable you to get a mortgage, lenders prefer to have collateral or equity in the property. Now, there's a difference between what collateral and equity is. If you ask a borrower how much equity you have, and they will subtract from estimated value of the property how much they owe, says this is how much equity I have. Lenders don't look this way. Lenders usually use loan to value, and I would say looking how much equity is left. In my definition, equity is misleading because equity is comparable with collateral, and where collateral is what is left from the equity after the property is sold on foreclosure. And we maybe 10 years ago we had quite few foreclosures, and they might coming back because people will not have money to make their mortgage payments. So collateral is defined by appraised value. So appraisers, human beings who are making mistakes as we do, go out, value the property, and make their conclusions. And then we receive report, and sometimes report is not exactly what we think it is. Or when we're checking information, we find that there are errors. And the errors affect our ability to make loans. And because reports are made by humans, they rarely change their opinions. Therefore, it becomes challenging. I'll mention later on a few cases where we'll have to go to different lenders because appraisers were not willing to change. Now, if it's collateral is number one, so number two is capacity. It used to be capacity number one, actually. In all the rules of Fannie Mae guidance, capacity was number one. I think it's number two because first you have to have equity. So what's capacity? Capacity is your ability to make mortgage payments. And lenders define it different ways. The easiest way is, of course, if you're a salaried person. So let's say you have good salary, and when we calculate numbers, you are qualified. But salary can disappear overnight. Let's say if you're working for a company is shrinking, they're closing their doors. This is what happening in mortgage business now. Many companies disappearing. So your salary, it becomes zero. So what kind of security it is? Well, it's not. But nevertheless, this is how industry is operating. Then there is the income of self-employed people. This is completely different way to analyze it. It analyzes based on the tax returns. Or there's alternative ways to analyze it, and this is what we'll talk about. We'll talk about alternative programs or creative way of financing. So after you know how much money client earns, now we have to look on the credit. Actually, we run credit right away. Because when you talk with somebody that says, oh, my credit score is so-and-so, which maybe is the case when you're checking on free sites, but mortgage lenders use different qualifications, so different criteria, different algorithm to calculate your credit score. And therefore, now our numbers might be different. Credit score depends on how much you owe. And it's how old is your credit, how long items you have on your credit report. There's many different ways how to look on a credit, and actually this is one of the ways to improve it. Credit scores can be improved. What's difficult to improve, how much you owe. Because how much you owe defines is how much monthly payments, obligations you have. And this affects your ratios. Then the next C is cash. Cash or capital is money using for down payment. Of course, it doesn't have to be in cash. Though I remember years ago when I started mortgage business, I came to one client and we were filling loan application, and I asked her how much money you have. That's $25,000. Said, we need more. Said, I have more. So, but nowadays, cash will not work. You do need to have money in a bank, or if you do not have your own money, down payment can be substituted by the gift from close relative. And we have cases, and I'll discuss them later, that when relatives gave 100% gift. In many cases, you have to have at least 5% of your own money to qualify for a mortgage. So we have, so far, we covered collateral, capacity, credit, and capital. So we have 4 C's. Everything what we need to create the transaction. So what's character? Character is what happens when you put all 4 things together. Because when you know all of those 4 C's, in our world, we decide which loan client can get. We check what interest rate, which depends on your credit score. We check sources of money. We see where your down payment comes from. And of course, this will determine how much equity or how much collateral you have, or lender will have. Basically, lenders don't care about your property. They don't need it. The only thing they care about how much you pay every month. And therefore, when you sign documents, it's called paid as agreed. And when you make your payments on time, you'll get your mortgage. Well, at least you keep your good credit. That's it for now. Until the next week when we'll start talking specifically about mortgages. Meanwhile, I can help you. I promise. Thank you.